Hello and welcome to this update on secured loans for the self-employed. It's quite a big topic and it's an important one for self-employed borrowers. So my name is Steve Walker, Promise Money, and what I want to talk about today are the things that might help you if you're self-employed, prepare yourself for taking out a secured loan or borrowing secured on your property, or if you're ready, it'll give you an idea of what's available. So let's firstly talk about what lenders look at, and there are a number of key areas. They're going to look at the security of the property that's being being offered, and they're going to look at the loan to value that they're going to be lending to. And when it comes to self-employed people, they're going to look at how long you're self-employed and what income you can prove. They're also going to consider what the purpose of the loan is and your credit history, and those are the main areas. The good news is that, unlike a few years ago, most of the products that are available to employed borrowers are also available to the self-employed. So you're not going to be penalised on rate per se, or on the products that you can get in most cases. So let's just take some of those items firstly. Now, security is a big factor. These are loans that are secured on property, and the type of security that you're offering is going to make a big difference to what's available to you. And the reason I say that, most people watching this are probably homeowners, are thinking about a secured loan secured on my house, but you can also get a secured loan or a second charge secured on commercial property or buy-to-let property. So if you secure it on your house where you live, that makes it a regulated mortgage, and lenders are very much more aware of the regulations and what will happen if they get it wrong, because the regulator is very keen on making sure that consumers are protected. So when it comes to affordability, when you're borrowing on your main residence, the regulator is very hot on this, and lenders are very hot on this, because they need to show that they've taken into consideration your circumstances now and what could happen in the future, you know, if interest rates go up and things like that. So there's a lot of stress tests built into there. And what that means in simple terms is it's tougher to prove that you can afford a loan to the satisfactions of a regulated lender than it is if you were doing, say, a buy-to-let loan. So let me just give you a bit of a flavour for what that means. So generally speaking, lenders are going to be looking for 2 years accounts as a minimum, but there are lenders that will consider if you've only been trading for 1 year. So you could get your first year's accounts done very, very quickly after the end of your first year, and you could be in business, and there'll be lenders who might be able to help you in that short space of time. And what they're going to be looking to evidence affordability is going to be tax assessments, accounts, or in some cases an accountant's reference to prove your earnings. If you keep management accounts, that's a really good idea, because that not only gives the lender something to look at, but if you do need to get accounts prepared or 6 months accounts prepared, it's a lot easier for you. And if you're a contractor, well, generally they're going to need evidence of the time that you've got left on your contract, or that it's about to be renewed. And a lot of contractors work under umbrella companies. That's okay too. But the affordability situation there, as I say, is, to give you an idea, if you're borrowing at a rate of 4%, the lender will probably assume that interest rates are going to go up by 2 or 3%, both on your mortgage and on your loan, and they're going to be underwriting the loan and affordability based on those higher figures. So that makes a big difference, especially if you're on a mortgage rate of 1.5% now. If that goes up by 2% or 3%, and they factor that into their calculations, that makes a big difference to affordability. Of course, it's a good idea because it's there for the protection of consumers if rates do go up, but it can be frustrating as well. So now let's talk about loan to value. Again, we're talking about your main residence here. If you're borrowing against your main residence, you can effectively borrow up to, well, there are lenders that will go up to 100% loan to value, certainly, and there are those that will even go to 120%. What I would say is that the sweet spot is borrowing probably up to 85%, and the best rates you're going to be getting, if we talk about rates as well, secured on your main residence, are probably going to be kicking in around about 65 to 70%, where you can get rates probably 4% or less. There are lenders certainly starting at lower than that. And as you go up the LTV curve, then the rates are going to go up accordingly. But you've got a wide range available to you, up to 100% and potentially beyond. So let's now just compare that to if you were securing a loan against maybe a buy-to-let property or a commercial property. Well, firstly, with regards to affordability, the lenders haven't got the regulations to contend with, so they probably are more relaxed. It doesn't mean they're going to take chances, but in terms of the stress test, they've got a little bit more latitude to look at a lower stress test than otherwise they might. And if you're maybe taking a second charge out on a buy-to-let property, they can look at the income from that property alone without really getting involved or worrying too much about your external your external personal income and your outgoings. So there are options that they have around that. Some of the downsides, of course, is if you're securing on a buy-to-let or a commercial property, you're not going to get the same loan to value. On buy-to-lets, as a guide, probably 20% what you get if you 20% less than what you would get if you're securing against your main residence. So at the moment we are just coming out of the COVID situation, hopefully, and most lenders are capping their secured loans at 75% loan to value. But when the market was a lot better, it was a lot higher than that. It was 85, 95, and sometimes even more. But generally speaking, you won't get such a high LTV if you're securing against a buy-to-let or commercial property. Commercial properties will be even less. And similarly, the rates you can probably expect to pay a couple of % more if you're securing against a second charge against a commercial or a buy-to-let property. So, as a rule of thumb, if you've got equity in your own home and you've got plenty of income, you're going to get the best deal by securing the loan against your main residence. And you can use those loans in most cases for business purposes. Okay, so let's just talk about proving income now, because you've probably there'll be some people watching this video now who've been around long enough to remember self-cert mortgages. Well, the regulator puts those behind us, really, and rightly so. But what you've now got a situation is that you do have to prove your income, and that's giving a lot of self-employed people a challenge, because sometimes their income doesn't always reflect what they do earn. I'm not going to say no more on that. But if the more income that you can show as taxable income via your accounts and tax assessments, the more you're going to be able to borrow. And because more lenders will be available to you, it's likely that you're going to also get better rates too. It seems almost as if the regulator and the taxman have got into cahoots and said, right, okay, well, we want people to be declaring their full income and paying the maximum amount of tax. So if they want to borrow, Mr. Regulator, will you make sure that that's what they need to show to maximise their borrowings? So it's a situation which, for a lot of self-employed people, I think people are used to it now, but that is the situation. The more you can declare, the more you can prove, the better it is when it comes to borrowing. Just touching back on self-certification, there are lenders who will do self-certification for business purposes, business loans. What I would say is, if you're going to be approaching a high street lender or a tier 2 or a tier 3 lender, they're not going to look at self-certification. They might look at projections if you get into tier 2 and tier 3 lenders, but they're not really going to be looking at self-certification loans. So if you're offered one, be careful, because my experience of those is that there's a sting in the tail. It's normally somewhere in the agreement, and the early repayment charges or the cost of getting out of one of those deals is massive, because they're structured very much like a leasing agreement. So if you take a loan over 5 years and you want to settle it after one, they may well say to you, yes, but this is a 5-year deal you've signed up to, and we want all the payments pretty much under that 5-year deal. So just take a lot of care there. But self-cert, yes, stick well clear of it. So let's just talk now briefly about loan purposes. Well, with secured loans, lenders are used to pretty much any loan purpose. Bear in mind that if you are saying, I'm taking out a secured loan to set up a new business and I'm going to give up my job, then the lender's not going to look kindly on that. But if you're saying, I'm setting up a new business for my wife, and the loan stacks up on your income, so that your wife's income isn't required, then that's fine. There are some really good products that have just come out as well very recently, which are, I think, aimed at self-employed mainly. It's effectively an overdraft product, so you only pay interest on the amount that you're borrowing at any time, and you can flex the amounts up and down. So it's a really great product for self-employed people who are doing property investments, and want to maybe do up a property and sell it, and they just need a pot that they can dip into from time to time. But it's equally good for businesses as an alternative overdraft facility. There's another video which please look out for that one, so it's on our website. Look out for that, and that will tell you more about that product. Credit profile, we'll just talk about that for a minute for the self-employed. Again, treated the same as employed people. And again, there is a video on our website which talks about credit. So if you've had credit issues in the past or even have them now, there are products available to you. Check that video out. But particularly for self-employed people, there are products that if you're in an IVA, you can even take out a product to pay off the IVA, and you can even take off products to pay off bankruptcies. So you know, in terms of credit profile, from prime all the way to what we would call heavy adverse, there are options available. So in summary, a lot of these loans for self-employed people will be secured on your main property, will be regulated, so proven income, the more that you can show and declare, the better it is for you. There are lots of plans for all types of credit and residential property, and a wide range of LTVs up to 100% for self-employed, and pretty much any loan purpose is okay as long as it's legal and ethical. Check out the innovative new products. Go to promisemoney.co.uk and you'll find details there, or underneath this video directly you'll see some links where you can get straight to some of the different products we do, or subscribe to emails and information from there. So I hope that's proved helpful, and please do get in touch with Promise Money if you need any further assistance. Thanks a lot.